This video is all about ETF rotation strategies, the pros and the cons of ETF rotation strategies, as well as where I found my favorite ETF rotation strategies that I like to use. Hi, I'm Camille Gaines here, and on my website, retiresurgeon.com, I write about and talk about investing. I'm not trying to sell you wealth management services. I'm not a financial advisor. I like investing. I love talking about it and sharing what I've learned over the years that I have been investing, as well as special concerns in retirement that relate to investing as well as income streams. Please don't construe the information in this video as personal financial advice. Again, I'm not an advisor, although I am a financial coach and I have some investing courses on my website. Okay, so the very first ETF rotation strategy pro, and I'll hit the pros first, is that an ETF rotation strategy can lower risk. That's right, a good ETF rotation strategy will rotate out of assets that are going down at the right time. So if you're an older investor like me and you may have ridden out those bear markets and not really liked riding out bear markets, you might decide that you don't want that risk anymore in your portfolios. And ETF rotation strategies are designed to rotate out of assets that are going down and into assets that are going up. Sometimes that rotation could be into cash, but that lowers risk. And if there's a good strategy that works and has worked well in the past, it's proven that it can rotate out of stocks when there's been a bear market, then that lowers risk for us investors. So that's the very first thing, and one of my favorite things about ETF rotation strategies. The next thing, or pro, about ETF rotation strategies that I really love is that you can invest in assets other than just stocks and bonds. Now, a lot of ETF rotation strategies that I see only invest in stocks and bonds. Those aren't my favorites. I like ETF rotation strategies that can rotate into assets besides stocks and bonds. I've already mentioned cash, but there are other assets such as TIPS, and while TIPS are a type of bond, most ETF rotation strategies don't rotate into TIPS, for example. And real estate is another asset, gold, commodities. So there are a number of different types of assets that ETF rotation strategies can rotate into, and I love that because if we look at an investing quilt, and you can check out my other video that I did on that, I believe the name of that video was the best investment over the past 10 years, you can see that in some years stocks are the best performers, and other years real estate's the best performer, and in other years, believe it or not, cash has been the best performer. So there are different asset classes that perform the best in ETF rotation strategies that have the ability to rotate into those various asset classes. Well, they have a real advantage over someone that can only hold stocks and bonds in their portfolios. The next ETF rotation strategy pro is that ETF rotation strategies can be done for almost nothing. The costs are extremely low. So you have buying and selling of the ETFs, which is now free, certainly on my brokerage platform, on most brokerage platforms, if not all. I'm not 100% sure about that. But free to buy and sell the assets, or the ETFs, and while there are some costs in the ETFs themselves, some are a little bit more expensive, like the commodity ETFs, most ETFs are very, very cheap. So this entire strategy can be done at a very, very low cost. I love that about it. The next pro of an ETF rotation strategy is they can take the guesswork out of investing. It is impossible to say exactly which asset class is going to go up or down at any given time. Now, you know, if you've seen other videos on my channel, I do think that we can look at really obvious way extremes in valuations and other signs that give us clues about where things are going, where assets are going. But we can't know exactly how long the stock market will keep going up when there's a lot of hype, even though stocks are overpriced. And we can't know exactly when bonds will go down. And there's so many factors that affect the prices of bonds. All assets are that way. So using an ETF rotation strategy takes a lot of the guesswork out of investing, and guesswork causes stress. It's unpleasant. It causes uncertainty, and nobody wants that when it comes to their investing. We can look at experts. You know, one of my favorite channels is the Wealthy On YouTube channel. I've talked about that in one of my videos here, the Advanced YouTube Channels video. Love Wealthion, but one expert one week will say that there's going to be a stock market crash, imminent, very soon and horrible. And the next expert is a bull market, all about stocks continuing to go up and there are no problems. And this can be all in 1 week. And that's no fault of Wealthion, the channel. Like I said, I love it. But these experts, no one knows for sure what's going to happen and exactly when. So taking that guesswork out with an ETF rotation strategy can make a lot of sense, and it can reduce the stress around investing. An ETF rotation strategy can be done with very little effort. Now, when I chose the ETF investing strategy that I use, and it's actually one that I put together from several portfolios that I really, really liked. And I can tell you how I do that. But having said that, once I went through the initial evaluation process and chose the strategies and did the research on the strategies, implementing the strategies takes very little time. In fact, it takes me about an hour a month to implement the strategies across multiple accounts, because some of the accounts are IRAs and some are 401ks and regular accounts. So less than an hour a month to implement those strategies. So that is a huge pro of ETF rotation strategies. If you've liked what you've heard so far, you like this video, my information, I'd love it if you would click that little thumbs up below the video and subscribe to my channel if you want to see my future videos in your newsfeed. Okay, the very next pro for ETF rotation investing is ETF rotation strategies can be done in most 401ks and certainly in IRAs. I implement my ETF rotation strategy, as I mentioned, in both types of accounts as well as regular accounts. The next huge pro of ETF rotation strategies is that they can be back tested by an independent company, not the company necessarily that developed the strategy, but by a third party that didn't develop the strategy. It's unbiased back testing. And I love, love, love this about the strategy. How often have we as investors looked at a fund, met with a financial advisor, looked at some sort of product, and what we see is a long-term average of how the strategy performed or the fund performed over a certain number of years, and it's an average annual return. It's annualized, and it's just a lump. It's just one number. It's all the returns have been lumped together, so we can't see the ups and downs that happened in that particular fund or investment that we're looking at. Whereas with an ETF rotation strategy, because they're based on indexes, and indexes have most indexes, major indexes at least, the data can be pulled for several decades. So ETF rotation strategies can be back tested to show the results, how that strategy would have performed over that time frame. And I love, love, love that about ETF rotation strategies. I'll dig deeper and take that a step further and say, not only are we not looking at that annualized average amount, we can look at these ETF rotation strategies by year and by month to see how much the volatility was on the way to that return. And so we know that these past results are not going to repeat themselves exactly, but we can see how an ETF rotation strategy performed in the past, during bear markets, during high interest rates, during low interest rates, during recessions, during different economic times than what we're experiencing at the moment, at the time we're evaluating the ETF rotation strategy. Because there's one thing for sure about investing. Things are going to change. The macro factors that drive the performance of our investments, they are going to change from year to year. They can even change from week to week. So this is super important so that we can look at that back-tested data, look at those past returns, look at the risk more importantly, and see if we can live with that, if that's something that will help us reach our financial goals. The next thing I really love about ETF rotation strategies is that most of them, many of them, were developed by financial experts that have spent years and years, maybe their whole career, learning how to invest and how to develop strategies that will beat a typical benchmark portfolio. So I love that we can tap into and capitalize on their expertise as individual investors. I just don't have that expertise. Yes, I feel like I know a whole lot about stocks and bonds. I've done it forever. I've bought and sold just about everything at this point, but I can capitalize on someone else that has been doing this full time in their career for many, many years. The next thing I really love about ETF rotation strategies is that these experts that have developed these strategies have an entire research team. I don't have that at my disposal, so I'm able to capitalize on someone else's research team to test these models, to develop these models to perfection, test them over and over until they reach the maximum capability of that strategy, and then I can simply implement it myself for free inside my brokerage account. Like that, to me, is a win-win situation. The next thing I love about ETF rotation strategies is that they are complicated, they're complex, they're sophisticated, but they're simple to implement. They are based on, usually, the ones that I use certainly are based on technical indicators, technical factors. So that's getting a little bit complicated, but it's super easy for me to implement. And here's what I love. That's so much better to me than following a simple asset allocation template where I put 60% or 70%, 80%, whatever it is, into stocks and the remaining percent into bonds. I did that decades ago. That is just not sophisticated enough for me anymore. I don't like that. It's a template, and I don't want to invest like that anymore. I want to invest based on, and this is the next pro and what I love about ETF rotation strategies, I want to invest based on opportunities that present themselves as they present themselves, and I want to invest based on avoiding risk as they present themselves, because things change in the markets, risk change, opportunities change, and I want an investing strategy that can capitalize on that has shown in the past that it can and does capitalize on those changes in the economic environment. Okay, now I've got a few cons about ETF rotation strategies. They aren't perfect. No investment is. Cash, money market, it's not perfect either as an investment strategy. So what are the cons of an ETF rotation strategy? Well, the very first con is they do require more effort than that asset allocation, that fixed asset allocation, that strategic asset allocation versus something more tactical like the ETF rotation strategies. So they require more effort. You do have to make rotations. That's part of the deal. Now, we all know, though, that if we're using a fixed asset allocation, we still have to rebalance that allocation at least annually. Some investors rebalance their allocations twice a year, some rebalance quarterly. So there is some rebalancing even in just those fixed asset allocation templates I was talking about, like stick 60% in stocks, 40% in bonds, and leave it there forever unless your life or until your life circumstances change. So it is a little bit harder to implement an ETF rotation strategy. The more often it rotates, then the more often you have to make the changes, of course, in the portfolio and place your trades for buying and selling the ETFs. The strategies that I use rotate only about once a month usually, so that's not a lot of work. Now, I have combined those three strategies and chosen the best days to implement those strategies, so it does get a little more complicated for me personally, but there are ways to make this really, really easy for ETF rotation strategies. The next con of ETF rotation strategies is that more frequent buying and selling of your investments can trigger short-term capital gains, and short-term capital gains are taxed at your highest tax rate. Now, everybody's different. Tax laws and rules are always changing, so this is something for you to research. Based on my knowledge and the way it's been for a good long while, when you buy and sell those assets, it's going to be taxed the same as your earned income. So that's going to be your highest tax rate. Whereas long-term capital gains, and there are some limitations here, if you make a whole lot of money, your income is real high, you lose the long-term capital gain tax rate goes up, but for most investors it's 15%, and on the low end too it can be lower, but for a lot of investors it's 15%, and that's a pretty good tax rate. But that's only for investments that we've held for a year or longer. So ETF rotation strategies that buy and sell assets, have a high turnover, it's called, they can end up resulting in triggering those higher taxes. And I don't like that about ETF rotation strategies. The good news is that they can be done in most retirement accounts so that they're tax-free or tax-deferred. There are those for those tax-advantaged accounts. The next con for ETF rotation strategies, and this one is, it's so extreme, I'm reluctant to mention it, but I'm not reluctant to mention it because I like to be I'm very risk averse, and anything that I say here, I want to be super careful to always point out kind of the downside because, well, the downside happens, right? I've invested through the downside. So that is that there could be a fallout in the entire ETF industry. It could happen. So ETFs haven't been around as long as mutual funds have been around, and that could happen. And with an ETF rotation strategy, most investors are using, well, obviously ETFs. Now, I've thought this through a lot. I've thought about it, and some of my financial coaching clients I work with on how I found and how to find and implement and research ETF rotation strategies and how to implement them. And so I think about this a lot. And one of the things I've thought about is you could do a rotation strategy. It wouldn't be an ETF rotation strategy. It would be an asset rotation strategy using index funds. Now, the only thing is you wouldn't be able to place the trades during the day. When the market is open, you would just have to buy or sell mutual funds after the market closes, which is really not that big of a deal because the ETF rotation strategies that I use are based on really long-term trends. So that's not really a big deal. But a fallout in the ETF industry, and I have no reason to think could happen. I just have thought, what could go wrong? Well, there could be a fallout, and I've seen just maybe one or two things about this on the internet. I've researched it, tried to find more information on the likelihood, and as you can guess, there's probably not much out there about this, right? Because it would be very well, it would be bad. And I think if this did happen, we would have a whole lot more to worry about than our ETFs. So that is, though, one potential risk for ETF rotation strategies. If you want to know how I found an ETF rotation strategy, make sure you watch my video on Allocate Smartly review where I step you through that. And remember, retire certain.